This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
It never gets dull with this podcast. So many interesting people, so many very smart people, so many very successful people. I get to stay in school my entire life. I mean, actually, I have a side gig of running my world too, but this is my educational option, my educational out, where I come to get schooled. Today, I'm getting schooled by Scott Kupor. He's a managing partner at Andreessen Horowitz. That would be Mark Andreessen, Scott's partner. Mark Andreessen, who happens to have launched Netscape back in the day. Very cool stuff. Something that definitely changed my life when it happened, that's for sure. And today, a subject near and dear for entrepreneurs, perhaps for venture capitalists as well, too. But there's probably far fewer venture capitalists than there are entrepreneurs. Scott's book, The Secrets of Sand Hill Road, Venture Capital and How to Get It. This is a cookbook. This is A to Z. I mean, he's telling you right there on the cover, venture capital and how to get it. And guess what? He tells you. He's not saying it's easy. He's not saying it's without work, but he's telling you how the process works. How you need to think as an entrepreneur, and how you as an entrepreneur need to think about venture capitalists and to understand how venture capitalists think. What are their goals? What are their desires? What are their constraints? Without any further delay, let me jump right into my conversation today with Scott Kupor as we discuss his newest book, Secrets of Sand Hill Road, Venture Capital and How to Get It. Scott, in advance of this conversation, I start to think of myself. I go into a time warp and I take myself back to 1995. I'm age 50 today, so not today, but I'm age 50. So you can guess that roughly where that puts me in 1995. And something big happened in the summer of 1995. At least I thought it was big. I think the rest of the world thought it was kind of big too. Now, convince me that I'm wrong, and I'm not just saying this because it connects to your office in some tangential way, but convince me that I'm wrong, that August of 1995 was not D-Day for the modern world of business. I sure think it was.
I think you're right. Look, I think it was a seminal time period because it's certainly the first time where, from a capital markets perspective, we saw some of the amazing things we've seen, kind of repeatedly over time, which is this idea that kind of the public falls in love with a story. Companies get valued in some cases, as you saw there, well ahead of what the fundamentals might be of the business. But because the promise of the opportunity and the long-term market opportunity is so great, I think the IPO of Netscape in August 95 it's not just a technological foundational piece, because of course we all know now what happens in the subsequent 25 years in terms of the foundation the internet provided for economic growth. But I think it does usher in this almost kind of populist in some ways and kind of, retail phenomenon around kind of tech stocks and, how they ultimately come out from a capital markets perspective.
Okay, I want to take all of the experience that you've had in the last 25 years and park it for a second. And I want to see Scott in 1995. Where were you? What were you doing when that IPO happened?
In 1995, I was actually going into my final year of law school at Stanford, having been an undergraduate at Stanford as well. So I had been living in the Valley since 1990. I will admit to you, as much as it pains me to say, that I was almost completely oblivious to the Netscape IPO and to what was happening. I was very focused on school and focused on what I was going to do for a career. And at the time, I was still thinking I might, in fact, actually be a lawyer. So some of this stuff, quite frankly, just went right over my head.
What was the time, though, where you had the pivot and you started to say, I'm in the Valley. There's something interesting going on. Everybody under the sun is going IPO from, dogs.com to pets.com, you name it, whatever. What was your light bulb moment?
What finally happened was I graduated in 96 and I had decided I would try one more kind of law firm gig to see if it worked. And I went to New York and worked at this esteemed firm called Wachtell Lipton, which basically is famous for its name partner who does all kinds of public company work. And I came away from that summer and I said, you know what, I'm just excited about what's happening on the business side of the transaction, not on the legal side. Basically scrambled from there to figure out how I could parlay my law school experience into a business job. Luckily, was able to convince a couple of partners at Lehman Brothers in San Francisco to take a chance on somebody who kind of knew a little bit of the life sciences side of tech, knew nothing about the business side of things, but I just convinced them that I would work harder than anybody else and figure out how to run the business on my own.
What year is this roughly?
97 is when I finally started there. As I mentioned, I went into the life sciences side of the business. And if you follow that business, life sciences was very active in the kind of mid 90s. And then right about 97, almost exactly to the day that I started working, the capital markets just completely dried up and nobody wanted to touch an IPO in the life sciences space. Luckily, as we all know, the IT space was incredibly coming to life on the heels of the Netscape IPO, but also, kind of in the run up to the 1999, 2000 time period. So I got a call from a friend at Credit Suisse First Boston who said, hey, we literally have 50 IPOs going on at once. We need people to sit at the printers. If you remember in those days, they had the financial printers where they would do the prospectuses for the IPOs. We basically need people to sit at the printers and help these companies finish their prospectuses and go public. This was a great example of kind of right place, right time. I just kind of plugged myself into what was an incredibly interesting roller coaster ride for the next couple of years.
You get that random call. I don't know, completely random, but you get that random call and you say, yes, you'll take it.
Exactly right. Yeah.
Was that some kind of deep understanding at the moment or just like a point in your life where you felt like pivoting? What was the driver there? Because a lot of people would have taken the call and maybe said, no, I'm happy where I'm at.
It was weird because I had literally only been at Lehman Brothers for about a year. And I'll never forget I'd also just been married for about a year. And I remember going out to dinner with my wife and father and mother-in-law, and I promptly told them that I was quitting this job that I had had for all of a year to go quit. And my father-in-law, who is he's probably late 70s or something, comes from the generation where people don't change jobs, period. And you certainly don't change jobs after 1 year. I remember him being incredibly disappointed and probably frightened for his daughter who had married me that I was going to be an impetuous person. But what it really was for me was I just saw kind of the excitement. And again, at that point in time, when you're in the working world out here in Silicon Valley, you couldn't help but just feel how palpable the excitement was around what was happening in the IT space. And we had no idea at the time where it was going, but it just felt like, look, if you're going to be out here and you have an opportunity to kind of at least participate, albeit as a service provider in this industry, that you had to kind of give it a shot. Lehman was a fantastic place to be, but unfortunately, since I was in the life sciences side, there was nothing to do that was anywhere near as compelling.
You're very calm, cool, and pragmatic about it. But I think if I think back to 1995 until when the dot-com bubble burst, for me personally, my gosh, it felt like the most insane. You must get in there now. You must grab a piece of what's going on. This is the most capitalistic moment in history. And you're very kind of pragmatic about it. What was it? This is what's going on. And I'm giving you a little bit of a hard time, but I mean, there had to have been a certain bit of a deep down in you, a certain bit of an excitement where it was like, wow, this is crazy.
It was amazing. And it was crazy and amazing. And it was fun. I mean, look, it was 24/7, particularly as a banker, having been in this life, you were living on planes, you were pulling all-nighters, but you were literally kind of getting dog years worth of experience in a very, very short period of time. And so as somebody young who was coming out of school, at the time, we didn't have any kids either. So there was no better place to learn as long as you were willing to kind of, sacrifice your own personal health to do so. It was just what people were doing. It was great. You couldn't not be part of it.
Now, what was the pivot for you? Because you happen to be at an interesting firm today, which people might call a venture capital firm. Something we're going to end up talking about today. But what was the pivot for you where you end up at this firm where a lot of people will hear about it today go, wow, Andreessen Horowitz, that's an interesting shop. So people want to know, what was the pivot? How did that start? What was the introduction? How did you make your path?
The pivot started it's a very long pivot. It started almost 20 years ago. What happened was I was a banker, as we talked about. We took a company public called Epiphany, which some of your listeners may have known. The person who was on the roadshow with me from the marketing team of the company said, hey, this has been a lot of fun working together. By the way, I'm quitting to go work at this company called LoudCloud. This is now September of 1999, and LoudCloud is a company that Mark Andreessen and Ben Horowitz and two other co-founders, Tim Howes and Insik Ree, started. He said, hey, I'm going to work there to do marketing. These guys are going to change the world. It's going to basically reinvent computing as you know it. You got to give up this drab existence of being a banker and come join us on the operating side. He said, "Do you want to meet Mark?" And I said, "Of course I want to meet Mark. Who would turn down that opportunity?" I met Mark. I met Ben. 2 months later, I once again quit a job that I had been with only for a couple of years and decided to give it a shot and try and build something on the operating side. And it was the same aha moment that I had when I kind of switched over to Credit Suisse, which was, if you're in the Valley and it's 1999 and you've kind of had an experience being a banker or something else like that, now you have to go try what it's like to actually be on the principal side and see what it's like to be in a company. That's what I did. And, that business we ultimately sold. But my relationship with Ben and Mark really dates to that 1999 meeting with them. Now I'm going on almost year 20 of having a professional relationship with the two of them.
Let me keep you back in time a little bit and let you pass along to the audience, because I'm sure there were many experiences early on meeting these guys where you were having these aha moments. Just, wow, okay, my view of the world, my understanding of the direction that I might want to pursue is radically shifting right now under my feet. What were some of those things in those first meetings, whether it was the tone of voice, the conversations, the body language, what was affecting you? Because obviously you can read the press clippings, the magazines, the IPO, all that kind of stuff years before. But when you were sitting down with the guys, what was happening?
I mentioned this a little bit in the book. It was sitting down with Mark and just his ability to tell a story, and I mean that in a positive way, not kind of, to kind of hoodwink people. His ability to kind of paint a compelling vision of what the world was going to look like in 10 years. I said this somewhat jokingly in the book, but it's true. He literally sketched out on a napkin in a Denny's restaurant. For those of your listeners who are not U.S. native listeners, Denny's is probably, the greasiest spoon restaurant there is, certainly in the U.S. It was just that ability to be able to sit there with somebody who, obviously I had a huge amount of respect for, because he was a luminary, having started Netscape and obviously having been incredibly successful in his academic and his professional life. His ability to kind of articulate, this is how the world's going to change. Compute as we think is going to be different. People are going to not worry about what kind of servers they're running or what kind of storage or networking or other stuff they're running. People are literally just going to be able to rent capacity to compute infrastructure and run the applications that they've built. And, as we know, of course, you fast forward to today, what Mark envisioned back in 1999 was essentially what is now Amazon Web Services. Unfortunately for us, he was probably 10 years ahead of his time in terms of seeing what the future would look like. That's what I remember walking away from and going home. And, when I told my wife I was going to quit my job and go do this, it's almost as if it compelled you to do something that was completely irrational at the time, to kind of quit a very nice job that was, very, paying very well financially. It was very secure, to kind of say, look, you're going to take, a 75% haircut on your compensation to go try something that has probably a 1 in 100, if that, chance of working. But if it did, you had a chance to be part of an incredible story. Again, I remember very distinctly telling my wife, I have no idea if this is going to work, but it's going to be a fascinating experience to be part of this. And that's when rationality gets overtaken by emotion.
Let's stay at story for a second and pivot into your book, The Secrets of Sand Hill Road, because this is a key part of your work. And I think for people out there that might have, and look, I'm not knocking engineering software is a huge part of you guys. That's your world. And I'm not saying that the spreadsheets are not important, but let's stay on story for a second, because you really make the case that story is where it starts. And I don't necessarily think that is going to be something that is intuitive for engineering types, perhaps even attorneys. Story is a little bit different. So that must have been an interesting thing, because here Mark's background, and then he's giving you a story that's compelling. That's an interesting mix of a person, isn't it?
It is, and it's a hard mix to find. You're exactly right. It's really the core of what I think very successful entrepreneurs do, is they obviously have incredible depth of product and technical knowledge. But what they're able to do then is to lead people, right? To tell people in a compelling way what it is that would cause somebody to quit their job or to kind of take a risk that, again, in many respects is irrational to do. As we evaluate entrepreneurs, it's something we really look for, because so much of the success of company building is a function of being able to do that. You've got to be able to recruit employees. You've got to be able to convince customers why they should give you a shot when it's incredibly risky for them to do so. You've got to be able to convince other investors down the line to give you more money to go execute things. So everything you do is a play on your ability to tell a story that has vision, that's compelling, that essentially kind of causes people to, quite frankly, line up behind you. Almost, it's almost in a missionary way to a certain extent. You're kind of an evangelist for a cause. It's an often overlooked skill set, but something that at least we found really kind of tremendous potential for success in this business.
So when Mark told you that first story, how long was the story?
We were having breakfast at the time. So the whole meeting was probably no longer than an hour and a half. Knowing Mark, it was probably, now Mark, for those of you who don't know, Mark basically talks, if you think I talk fast, Mark speaks at about 2 or 3x the pace that I do. We crammed a lot of content into an hour and a half meeting. He didn't give me a PhD dissertation. He gave me kind of the 15-minute version with a bunch of graphs scribbled onto a napkin about what was happening in the world, how it was going to change, how what we were doing was going to make it work. It didn't require any more explanation than that, quite frankly. I mean, I was sold after probably 10 or 15 minutes. The story doesn't need to be a complete novel, but it needs to be kind of the noveletta that gets people hooked and causes them again to kind of say, like, tell me where I need to sign up.
Well, so now here you are all those years later, 20 years later, and people come to you and they want to tell you stories. You can't help but not think in the back of your mind, the original story that was told you, the time that it was done in, and you kind of, I mean, to some degree, you're going to hold people to the fire a little bit. I mean, you don't want to hear someone come in and their pitch, their story is hours and hours. They're not going to get hours and hours, frankly, but it's got to be tight, right? Doesn't it? I mean, that's a real trick to get a compelling, large scale potential opportunity into something brief. I only get so much time with Scott. Heck, I'm getting more time with you right now interviewing you than most people probably get pitching you, right?
I think that's exactly right. What I will say is not true, though, is that everybody kind of talks about the elevator pitch, right? You've probably seen that in almost every book you read about you got to distill your business to if you're stuck in an elevator with somebody for 2 floors. That's not really how business gets done. I mean, yes, that's wonderful if you can give people the one sentence to at least kind of get them excited. Most of what we're doing is, we're probably spending, at least on an initial meeting, 45 minutes to an hour with somebody. And in that time period, we want to hear the story. We want to hear about them as individuals and team members. We want to hear about kind of their plans for how they're going to build the product, how they're going to sell the product. I mean, there's a lot to cover in that time period, but it all needs to kind of weave into a consistent story that says, we are going to go conquer this incredibly massive market. Here's why what we're doing is so important. Here's why now this is so important. And then let me convince you why us as a team is the right group to actually go execute it. That's basically the arc of the story that we want to be able to hear.
When someone sits down in front of you, not their bio, not their product idea, not their team, all that kind of stuff, but when an individual, a human being sits down in front of you, what kind of internal rules have you developed to size them up? How do you size up an individual that sits in front of you? Ultimately, it's going to be character and ethics and morals. These are going to be some of the key things. I mean, the individual could have all the greatest background and ideas, etc., but if that person is flawed in some ways, how do you try and detect the flaws?
We're certainly all flawed in many ways, but what we try to do is we really try to start with first principles. And quite frankly, we start almost all of our pitch meetings with, don't open the slide deck, but just tell us about you. Go back as far in history as you're willing and comfortable to, and tell us about your life experiences. Where did you come from? What kind of formative experiences did you have in life? It's surprising, maybe it's not surprising, which is you can learn a lot about people if you kind of understand their background a little bit, and you hear often things that they struggled with or circumstances they went through. And a lot of those really help kind of, help you at least determine kind of the shape of their character and the shape of their trajectory. A lot of what we do, of course, afterwards, if we're serious about something, is we do a tremendous amount of kind of reference checking with people. A lot of that is trying to find people who may have worked with this individual before or may have gone to school with them. We try to kind of go as far and as deep as possible in those conversations, also to try to get to, you're exactly right, which are the intangibles, which is this somebody that people want to work with? Do we think this person will be able to hire and manage individuals who might be senior to them in age and senior to them in expertise in certain domains? It's a lot of trying to piece together, quite frankly, the puzzle of somebody's character through a series of meetings, the storytelling, their ability to present the information, and then ultimately for us to hopefully find as many people we can talk to who've encountered this individual in their life, can speak to their flaws and their areas of expertise.
Let me ask a story question in a slightly different way. You've presented one story that was obviously great, the one that Mark sold you on, right? So that's a fantastic story. That one worked quite well for your life. What's a great example, though, of somebody, and I'm not asking for a name or their particular opportunity or whatever, but someone sitting down with you that perhaps had a great bio, all the details that needed to be there, but they sat down and they had a blind spot. The story didn't work, or they couldn't understand why it didn't work? Give an example of how story goes wrong.
The biggest problem that we find is there are things that just don't hang together that are inconsistent in the story. And there's a couple common threads around that. One is we hear about somebody's background and what they're doing. We think that's going to lead them to a certain business area or a certain product direction. And then we end up with a story in some other area that maybe they've actually figured out and they know something about, but almost feels orthogonal to where their experience and their kind of true passion comes from. Often when you have this kind of disconnect between kind of founder background and then the direction in which the businesses they're pursuing, those are things that kind of give you cognitive dissonance on the story. The other big one I would say is we have them paint an incredibly aggressive and exciting story about how big the market is and how wonderful the opportunity is and how they're going to conquer the world. And then you get to kind of either their financial projections, or you get to their go-to-market strategy, or you get to my least favorite slide, which is, oh, by the way, if none of this works, don't worry, we'll just sell this company to these 5 people. You kind of have this massive exhale where you just kind of, you feel let down, which is, I was with you the whole way, everything sounded great, and then it looks to me like the level of aggressiveness of your actual plan against the story you're telling doesn't actually fit together. It's those kind of disconnects that you kind of walk out of the room and you're like, oh man, like I thought we had something there, but it just feels like great idea, but probably we need a different team who actually is able to kind of better meld the story with their experience with kind of the level of aggressiveness that they want to attack the market.
Before we even get into the batting average of potential investments that your firm might make, what's the batting average for the pitches that come in front of you? In terms of like what percentage of those pitches, if 20 come before you, how many are causing you to go, you know what, we're going to potentially put some capital here?
As a firm, we see probably somewhere between 2,500 and 3,000 opportunities a year. Basically, I would say maybe as much as a third to a half of those you can kind of eliminate fairly quickly, either because it's an area that we just don't focus on, or it's a geography, or it feels just too early. So there's kind of relatively easy ways where I think you kind of knock probably almost as much as half of those off. But then for the ones that kind of get through there, we end up probably doing, call it 20 to 30 deals a year. From the very top of the funnel, you're probably talking about a 1% conversion rate. If you kind of take it from that middle part of the funnel, right, you're probably talking, what is that number? Probably 2 to 3% conversion rate, something like that. So it's pretty small. But I will say from a very positive perspective, the number of times you walk out and you kind of scratch your head and you say, gee, that's not an interesting idea, or that's not a very aggressive plan, or that feels like a once done company already, is very, very small. It's amazing. You spend a day out here or in other kind of venture firms, it's hard not to be optimistic about the future because the kinds of things people are doing, even if you don't agree that they are great business opportunities, are just incredibly ambitious and cutting edge from a technology perspective.
As I hold this fine-looking book in my hands, and it is a fine-looking book, I have to say, this is one of these books. Sometimes we all know, we see books that don't look that nice. This one looks very nice, as you know. That 2% that make it, in many ways, I think that's what your book is doing. This book is really telling the 98%, hey, you didn't think about this in advance.
I have 2 goals with the book. One is exactly that, which is, can we help entrepreneurs who, yes, might, otherwise benefit from learning how the VC business works so that they can appropriately tailor their storytelling and obviously what they need to match the incentive structure that their VCs have. And then the other objection is, could we potentially increase the size of the pie, right? So not just increase the conversion rate for people already in the system. Can we help people who are not necessarily in New York or Boston or California in the US, or not necessarily in Beijing or Shanghai in China, who just may not otherwise be aware of or inclined to understand the entrepreneurship ecosystem, but who can hopefully learn how the system works, and then hopefully we increase the size of the opportunity set for everybody involved.
Let me pivot to kind of a functional, operational aspect to investing from your perspective. For someone like you, we mentioned, we had a brief conversation before this conversation started, and not to share any names unless you want to, but we talked about a trader and his way of looking at the world is to say, I've got this landscape of opportunities across potential futures markets. I've got commodities, I've got currencies, I've got ags, I've got all these different things I can pursue. And I don't know at the beginning of the year which one is going to take off or not take off. But hopefully I'm going to catch some of these big winners along the way, but I'm going to have to try a lot of these losers that don't work out. I'm going to have to kind of cut my losses and let those winners run. The old David Ricardo thing, right? Tell me, how much different is your world than that?
So I think that the mechanism is generally the same, but I think we have a very different approach in the sense that, you remember on the trader side, and look, I mean, let's assume we're talking about public equities. We both have the same downside, which is unless we're talking about shorting stuff, we both have the risk of capital that we invest in the company. We have the risk of losing, but we know the downside is capped, right? We can only lose the amount of capital that we put into the business. Again, let's take out shorting for the time being. The big difference in our business is if we do it right, we should have effectively uncapped upside for the things that work. Whereas, if you're a trader in municipal bonds or public equities, you theoretically have unlimited upside, but the reality of those businesses is just if they grow at 10, 15% compound interest, that's good. In our business, if we can't grow things at 5, 10, 15, 100 times cash on cash multiples, we're probably not doing our business. But the approach is very similar, which is we're going to make a bunch of what I would call kind of long dated, out of the money options purchases is essentially what we're doing in our business. That's, I think, the closest analogy to financial investing. A lot of those options, unfortunately, are going to expire worthless. Probably 40 to 50% of them are going to expire worthless. Maybe 20 to 30% will expire with us having exercised and made a little bit of money. The real difference between success or failure is what happens on that last 10 to 20%. Do you end up with things, as I mentioned, that can get you 10, 15, 100 times your money? If so, you're going to have a successful business. And if not, you're probably not going to raise your next fund.
Yeah, you make a good point about if you're comparing to trading some whatever instrument, the chances of it becoming a quote unicorn, they're not the same compared to your VC space.
I think what that means for a trader is their ability, therefore, to they've got to think more about kind of capping their downside more than we do, right? You probably can't afford as a trader to have 50% of your things go to zero because you just can't make it up on the things that can go up. We have the luxury, at least, of knowing that we can afford to be very far on the risk curve. The danger, of course, is we're far on the risk curve and we make bad picks. There's no saving us from that problem, but at least, you have the potential to get there and be willing to accept a very high attrition ratio on the business.
I stole a line from your work here, funding the right entrepreneurs by providing something more. Well, we've been talking about the right part of that sentence. What I'm curious about is the something more from Andreessen Horowitz. It's not a short answer. So as I say that flippantly, I know we could talk for a long time about that. So
I'll try to keep it relatively brief, but let me just give the listeners one kind of frame for it, which is the big thing that's happened in venture capital over the last 10 to 15 years is that capital is no longer the scarce resource that it once was. It used to be that the venture capitalists had the money was scarce. And so if you were an entrepreneur, you had to go get it from the venture capitalists in a way where the venture capitalists probably had more power and more control over the relationship than did the entrepreneurs. That's really changed over the last 10 to 15 years. The amount of capital required to start a business has fallen. The availability of capital has grown. The entrepreneurs, quite frankly, are really much more in control and have choices for who they want to work with. What that means for us then, in terms of your original question, is we believe very strongly that a venture capitalist who simply is a provider of capital probably is not a great business to be in long term, and that you have to figure out what else can you offer an entrepreneur that makes them compelled to want to work with you and that adds value and hopefully increases the likelihood of success and or the magnitude of success for their business. What we've done at Andreessen Horowitz is basically to build an entire team. So we have 170 employees today, and 100 of those employees are there to help our companies grow and expand as quickly as possible. And they're doing everything from helping them identify sales opportunities, to helping them identify executives that would be helpful to them to grow their business, to working with the business press and the trade press to kind of make sure their stories are told in a way that actually helps them reach customers and reach employees, all the way through to helping them kind of raise capital from subsequent rounds of financing in their business. So we believe very strongly that kind of whatever your form of value add is, that's a critical piece of ultimately being successful in what is a highly competitive business.
It is quite motivating to see your work, though, because I think a lot of people, very bright people perhaps that have an entrepreneurial bent, your industry, your world, Sand Hill Road, can seem mysterious. When you go through your book, you've got nitty gritty in here. This is getting down legal accounting. This is not just, I'm taking you kind of on the story venture today, but your work is extremely detailed. You really are kind of like nuts and bolts. Here it is, ladies and gentlemen, this is what you really need to think about. But that talent constrained part, I think it's quite motivating the way that you talk and the way that you've written, because there's never been a better time for someone that has really put the time in and has got a great idea for an opportunity to go forward. Today's great, isn't it? I mean, it's not, people sometimes think, oh, it happened before. It's not a good time. Today's fantastic.
If you look at kind of almost any metric in the business, the amount of capital that venture capital firms are raising from their limited partners, their investors, the amount of capital that's being invested. Last year, as an industry in the US alone, we invested over $100 billion in venture capital-backed companies. We're on a pace this year to basically roughly do the same. Yeah, you're absolutely right, which is the number of firms out there, the amount of capital. Entrepreneurs are really in a great spot, which is effectively VCs are competing for the right to be able to fund companies. Now, the one big caveat to everything I just said is that is highly not normally distributed, in the sense that it's great if you live in Silicon Valley, or it's great if you live in New York or Boston, or even some of the smaller markets in the US like LA or Seattle, but it's still pretty poor in terms of access to early stage capital if you live in a number of the other 45 states that we didn't mention in the US, or you live in pockets of Europe or Asia or other places that don't have the same infrastructure. I think we've done a great job, at least on a localized basis, of, yes, making this an incredibly attractive time for entrepreneurs to raise capital. I think the big challenge for the industry is for us to distribute that across geographies, obviously do better distribution in terms of gender distribution of founders, ethnic distribution of founders. So there are certainly things that we still need to do to kind of achieve the vision of actually getting to entrepreneurship more globally.
I spent the last 7 years in Asia. When I look at a country, for example, like Vietnam, I see 100 million people. I see 50 million below the age of 35, all connected like crazy, all want to start a business. They don't really have an understanding of something like the Valley. So their ability to gather capital to get started is much more difficult. And I think from my perspective, building on your work here, it's like, my gosh, the world is so flat, and it is so big, and so many opportunities. And it's just, if you want to convince yourself that there are no opportunities, you're just you're just making excuses.
There's no question that talent is incredibly well distributed across the world now. There's incredible engineers and product thinkers in all kinds of places. I think the critical piece that a lot of these newer or lesser developed markets need is, you really need the kind of early seed stage capital. That, I think, is very hard to replicate from outside the area, and people kind of getting on planes to do those types of deals. I think at the early stage, having that infrastructure in country and in city makes a huge difference. As you get slightly later, the market becomes more efficient, and people will get on planes to go write 20 or 50 or $100 million checks. So I don't think every geography needs to solve that problem. A lot of what you need to solve is the early stage seed market, and then just making sure it's kind of the principle of comparative advantage, which is, what is it in your geography that you're going to be uniquely known for that allows you then to amass a critical set of engineers and executives and managers who all kind of have the appropriate domain expertise. And then you can kind of grow out from there and kind of have a much more horizontal development of your broader technology industry.
To go down the path, the point you just made a little bit there, I think sometimes American business people, entrepreneurs, they take a plane to Beijing, they land, they spend a week, they go home, and they think they've done business. And like, if you know Chinese people, it doesn't work that way. It's dinner, it's becoming friends, it's all these things, which gets back to your local point. Let's say you're a Caucasian investor or whatnot, and you're in the States. Literally, if you think outside the States might be an opportunity, you might have to relocate. You might have to go local. You're making that local point.
It's true everywhere. Lots of things happen around the water cooler, or people kind of just spontaneously decide to go get a cup of coffee or go to dinner after work and stuff.
Or Denny's. Denny's even.
Exactly right. Denny's too. That's right. But no, I think you're exactly right. I think we're doing this conversation over Skype. For as wonderful as these tools have gotten in terms of, kind of making the world feel smaller, there's no substitute for the basic blocking and tackling of relationship development in this business. I agree with you. I think it's very hard to be remote in this business if you're going to do early stage effectively, because there's just too many serendipitous opportunities that you'll miss to build a relationship in a way that will solidify the opportunity on the business side.
So here's the big question for you. I'm sure people make it into your office all the time, and this comes up. Should one raise venture capital?
We do get that question, and certainly, as you know from the book, that's part of what we were trying to deal with. The answer is, it depends, is the very honest answer. It kind of depends on what kind of business you want to develop. If you go back to first principles that we talked about earlier, which is, we're in a business where, as I mentioned, we are buying kind of long-dated options where we're looking for uncapped upside with the understanding that there is going to be very high downside risk on these companies. That's really the first foundational question, I think, for an entrepreneur is that the kind of business that you want to build? Do you want to try to build a Facebook or a Google or a Airbnb or something like that, that hopefully can be a very large and very successful and global business? If so, then a venture capital partner can be a very useful partner from a capital perspective, from a value add perspective. But if you really want to build something that you might call more of a lifestyle business, which is maybe it's never going to be global, maybe it's just in a few local markets, maybe you're more interested in generating wealth for yourself because it generates cash flow that you dividend out to yourself and your shareholders. Those are businesses that probably don't do well on the venture side because you've just got incompatible objectives at the end of the day.
Let me ask you kind of a lifestyle question, just kind of as a side tangent before I jump back in the book. In terms of living and breathing your life, your lifestyle, the last 20 years, how have you felt? No, have you been able to keep a certain balance? You said you speak very fast. You do speak very fast. I'll give you credit on that. And you said Mark speaks even faster. I think, oh my gosh, I'd have to practice on that one. But have you been able to find a certain balance? I mean, I'm guessing yes, but I'm guessing you also have had a chance to witness plenty of people that come through the Valley that don't find the balance.
It depends on who you ask that question. If you ask my wife, I think she will tell you no. If you ask my kids, I think they will probably be somewhere in between. And then, I think I can do it. But I think the honest answer is this is a place where people run fast and people work hard. The decision to actually enforce some kind of work-life balance is a very personal one that it's only doable if you as an individual decide to do it. Every incentive structure that's here in the Valley will point you in the opposite direction. If you have a natural type A personality and you layer that on top of an environment that probably exacerbates people with type A personalities, the only way to stop that is you just have to ultimately decide that that's not the priority and that's not the way you're going to run your life. Look, I would say, if I'm being honest with myself, there are plenty of times in my career where I'm sure that I have been on the wrong side of that equation, and I try to be conscious of it. The environment itself will always push you in one direction. And so the only way to do otherwise is to decide that you're willing to kind of go against the grain and try to enforce some boundaries that allow you to do the things that you think are priorities in your life.
I did not ask that from a negative perspective at all, because you're talking to somebody who I'm not sure if I know what the balance is. So
it's a very hard question. Yeah. I certainly didn't take it as a negative question, but I think it's a very real and fair question. And, I think something that I will admit, certainly I struggle with a lot of the time is to figure out how do you sharpen those boundaries in a way that still allows you to accomplish what you're looking for on the professional side.
Let me ask kind of a technical question, which with a little bit of a story here. I'm very curious about something. And look, your book is dense. There's so many different directions that people can go in. I mean, I highly recommend if people want to go down this path, you've laid out like, look, this is what you got to understand. My thought, my question, my idea traces back to the guy that owns Facebook and the way the voting has been set up, the way it's been set up from inception. My understanding is he has a great deal of control. Is that rare these days?
It's actually less rare these days than it was, quite frankly, probably 15 years ago. Facebook has what you might call kind of a dual class structure, meaning there are certain shares that have more votes than others, and those shares are disproportionately held by people like Mark Zuckerberg and other kind of early investors or founders of the company. And then there are kind of shares that have lesser voting power that are held by the general public writ large. What's happened in the US, at least over the last 15 years, is there's been a number of trends that I believe have made it harder for companies to be public companies. We know in the US that the number of publicly listed companies has shrunk by about 50% over the last 20 years. Overall, the market has moved more kind of short-term in its thinking, right? If you look at holding periods for stocks, they've all fallen very precipitously. What's happened in the technology industry as a result is there are many kind of founder-led companies where, as they've gone public, those founders have said, look, I don't want to necessarily be at the short-term whim of investors when I've got a long-term product strategy that's going to require investment and may take time for us to kind of yield the benefits of that investment. These dual class structures have been put in place effectively to give, a longer runway for those types of individuals. Not surprisingly, it's controversial. And if you talk to a lot of the kind of core institutional investors in the investor communities, they will tell you they don't like that they believe that, kind of it should be one person, one vote regardless for everybody. But it's really been a reaction in the tech community to this feeling that the kind of short-term nature of the markets is somewhat incompatible with the long-term nature of product development in these companies. I suspect it's a trend that's not going to go away anytime soon. I think the numbers I last saw were about 25% of the IPOs that happened in the US for each of the last several years had some type of these dual class structures put in place.
If I'm the new entrepreneur and I walk into your office and I think I've got something that in my imagination allows me to feel like, oh my gosh, I could be the next Jeff Bezos. And I'm looking at Jeff Bezos, who had Amazon going public and then basically a flat line on that share price forever, wasn't going anywhere. I mean, obviously he knew, he had a firm belief in the long-term plan on where it was going to go, but a lot of other people didn't. So I think probably a lot of entrepreneurs are looking at that and saying, my gosh, he's kind of laid the blueprint for me.
I think that's right. And I think that's what a lot of them are looking at, is because most of the people that we see, even though we know the numbers won't support that, most of the people we see aspire to or think they will be the next Jeff Bezos, or they will be the next Mark Zuckerberg, or the next Larry Page at Google. They're incredibly passionate about what they're building. Sometimes people kind of give them a bad rap, which is, look, this is all about control and ego. But the reality is, look, they're just incredibly passionate entrepreneurs who have a very long-term view of how their business can evolve. They want to know that they have kind of that flexibility to run the business in the way that they think can both do tremendous good in the world, but also, quite frankly, maximize shareholder returns. And so, yeah, you're absolutely right, which is in the era of having seen a lot of these companies go public with these dual class structures, most of the entrepreneurs themselves believe and aspire to be in a similar type of situation, should they be so lucky to go public.
But see, as you make the case in the book, there's two sides of this coin. There's the entrepreneur that wants to do well and has their vision, but then that entrepreneur needs money. And the venture capitalists, they have a different worldview. They have constraints and they're working with pensions and endowments, and they need to have a little more grounding, a little more detail of when they potentially might be able to get their return back. So I think you make a great case, you make a great point across your work. Like, look, if you're going to do this, you got to understand how Scott thinks too.
Glad that came across, because, yeah, look, a lot of the book, I think, is you'd be crazy, for example, to marry somebody who you didn't understand what motivated them, and make sure that you were kind of simpatico in terms of what you both wanted in the world and out of your relationship. For better or worse, not to overplay the analogy, but a venture capital partnership is very similar, right? Which is, if you're an entrepreneur and you're taking money from a venture capitalist, you're probably working with that individual very closely over an 8, 10, 12-year period. For you not to understand what motivates them and what incents them and what constraints they have, that would be just a poor way to go into a relationship. And there's no reason why you should treat this relationship any differently than you would others, which is know people, date them beforehand, understand who they are as a person and as an organization, and make sure that you're ultimately partnering with somebody that you are aligned with.
I'm guessing, I could be wrong, I might be saying this too far, but this book, to some degree, is answering a feeling you have where people must occasionally show up in the office and just view you as a check, and they don't think about all the other details that go into it.
VCs are people too, right? I mean, come on, you got to give us some respect, right? I think that's right. Look, the point that I try to make in the book is, look, there's lots of ways to raise capital, right? And look, venture is one of them, and that's great. And there are some people who do come in here and say, you know what? All I want from you is a check. That's it. I don't need any help. I don't want anything. And, that's understandable. We may disagree on whether that's the best way to try to build your business, but there are certain people who do that. It's a very small minority. But most people, I think, fundamentally at heart, want to find somebody who they can partner with, who is going to help them be better as a CEO, think about kind of get the benefit of their expertise and having seen hundreds of companies before them. And that's what I think, we aspire to do here at Andreessen Horowitz. And what I think most VCs aspire to do is, let's not just be a capital partner. Let's be somebody who actually can be hopefully a constructive participant as a board member. By the way, as I mentioned in the book too, respect the boundaries and make sure that we realize that, look, as a board member, we are not running these businesses. It's the entrepreneurs who are doing the real heavy lifting, but we can provide guidance from the sidelines and provide kind of support in other areas. But let's not make any mistake at the end of the day who's running these businesses and overstep our bounds.
I got one last little question for you, kind of a wind down. I noticed that you did not have an intention to write this book. This was not a plan initially. Obviously, it became a plan, but it started off a blog post. I relate to that. My first book was the result of 8 years of blog posts. And then I was like, oh my gosh, there's enough here to write a book. What am I doing? Let's write a book. Because you're talking to a guy who had no book writing skill at all. And then all of a sudden a book comes. Talk to me about your process, how that unfolded. I mean, you say it right there, but I'm curious. Was it that simple? Like all of a sudden I've got enough content, let's do it?
Yeah, it was a little bit of that. I've been doing writing on blogs for a while. And if you follow our firm, of course, you can see we try to be fairly prolific on putting out content. A big theme of our content is kind of trying to explain things, basically, either explain our view of the future of technology or explain how we think industries will develop. And then also, quite frankly, explain the business of entrepreneurship and venture capital. And so I kind of have always written on that latter category. What happened was I had some time off on a Christmas break, decided that I would kind of put some more blog posts together just to kind of complement things that were out there. And just what I found over time was the combination of thinking through that and then kind of going through in my own head of all the questions that entrepreneurs have asked me over the years, it felt to me like as I got started that there was just more of a corpus of information that I could provide than could neatly fit into certainly, 140 or 280 characters and then importantly into a blog post. That was really how it kind of was born. Maybe in some respects you say it was kind of born organically. Before I knew it, at least I had something that I felt like with the benefit of time, obviously I could turn into a full-fledged manuscript. I was lucky to have great support from the firm here and from my teammates here to allow me to do that. I hope it adds to the literature out there that gives people a better sense of the business.
It would be a whole different conversation, but it is kind of sad that I think there is a certain segment of the population out there, intelligent people, who probably believe that if you could not condense your book into a tweet, that it's not worth reading. Sadly, I think that's become somewhat the case these days. But hey, the book, Secrets of Sand Hill Road, Venture Capital and How to Get It. Scott, great stuff. You're welcome to give a website out if you want to send people to places, but I kind of figure maybe it's a good filter. If they can't figure out where you are, it's probably a good filter to avoid them. Maybe, if they can't, after this conversation, if they can't figure it out, just forget it. Stop.
That may be true, yeah, but I'm a very prolific Twitter person, so I'm at SKUPOR on Twitter, and then of course you can always go to our website at a16z.com and get all of our content and activities. But it's been a real pleasure talking to you, so thank you so much for the time.
Scott, thank you. And when the second book comes, because there's always a second book, please keep me posted.
Will do. Thanks again.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.